This is a stock market hanging on every single economic report as the economy slows down. Let's dive into all things economy with Goldman Sachs chief economist Jan Hatzius. Jan, always great to get some time with you, especially at your big conference here in September. Thanks for joining us. Maybe you could help us settle a debate we're hearing about in the markets. If the Fed will front-end load rate cuts, where do you stand on that?
Whether they will, we're still in the 25 camp. I think that's more consistent with the data that we've seen since the weaker than expected jobs report a month ago. I think Friday's numbers were, while a little softer than expected, nevertheless they did show a rebound. Q3 GDP is still tracking 2.5%. Jobless claims have come down. And then if you look at the Williams and Waller remarks on Friday, I think they were more consistent with 25 basis points on September 18th. I wouldn't rule out 50, but 25 does strike me as more likely. Now, in terms of what the rationale might be for doing more, I think there is a solid rationale for doing 50, and the rationale is that 5 3/8, 5.25% to 5.5%, is a really high funds rate. It's the highest policy rate in the G10. It is, despite the fact that the US has actually seen more progress on inflation than most G10 economies. So you could certainly make the case that they should be bringing down that rate quickly. Now, I think 25 is also defensible, though, because the way that monetary policy affects the economy is via financial conditions. It's not the level of the funds rate itself that matters mostly, but really financial conditions, and they depend on the path. If they do 25 basis points, I would expect them to signal clearly that there's going to be a series of cuts. I would also expect them to signal clearly, as Governor Waller did on Friday, that they'd be very willing to scale up the pace if the data disappoint. So it's, I think 25 is defensible. 50 you could certainly make a case for, but more likely 25.
What would a 50 basis point rate cut signal to investors? Would it signal that this is a Fed worried that the economy is slowing down more than expected?
Well, that's one of the challenges, and I think this is one of the reasons why the committee usually wants to go gradually, because that can be sold more as, look, we're just making some adjustments here. There's no reason to panic. And I think the people in the room that will be arguing against the 50 basis point cut probably will say, what does it say to the markets if we're doing 50 here? I think you can manage around that. You can say, for example, that this is really about just the level of the funds rate. Economy is doing fine, but the inflation emergency is behind us. And so therefore, we just think the current level of the funds rate is no longer appropriate. But it's always a risk, and you could get, at least in the near term, a more negative reaction because those kinds of concerns are prevalent in the market.
Why is the economy slowing down? Is the economy slowing down because of all the rate cuts that the Fed took, or there's something else at play here?
Well, I don't actually think that the economy is slowing down all that much. Yes, it is slowing relative to where it was maybe 6 months ago for sure, but that was very rapid growth, 3% or more. We're still tracking 2.5% growth in the third quarter. Our forecast for next year is only a few tenths below that, 2.25%. Those are very solid numbers. I think the main thing that's happened is that the unemployment rate has risen by 0.8 of a percentage point after the latest number on a spot basis. But a lot of that has been increases in labor supply. You've had this very large immigration wave, especially in 2023, a lot of that unauthorized immigration. And a lot of those people have entered the workforce and now are still entering the workforce, and it's taking some time to absorb them. And in the meantime, the unemployment rate rises. That's my hypothesis for what's going on. And So I think it's more the labor market rebalancing, labor market softening, rather than a big slowdown in growth.
It's not lost on me, a lot of the leaders that are in this room. NVIDIA CEO Jensen Huang will be here. We're talking to AMD CEO Lisa Su, a lot of AI-focused companies. When you're talking to these executives and you're in a conference like this, are you going to come away thinking that AI is really going to impact the economy, maybe more than a lot of folks think? And then what does AI mean to the US labor market a couple of years from now?
So I'm definitely in the camp that AI will have a very meaningful impact on the economy. I do think that it's important to distinguish between particular sectors of the economy where that impact is very visible now. Certainly, data centers and energy, there are significant effects from AI at this point in time. And then the broad, $28 trillion of US nominal GDP, where it's still going to take, we think, several years before we see major effects. So that's sometimes the reason for the disconnect between maybe what the macro people say and what corporate leaders say in the space. I think in terms of the macro impact, say 5-10 years down the road, we lifted our long-term growth forecast for the US on the back of AI from 1.8% per year to 2.2% per year, sort of in the early 2030s. And that's a pretty sizable number. Obviously, it's not as dramatic sounding a number as some of the more maybe micro or sectoral effects, but for a $28 trillion economy, it's or whatever that number is going to be 5 or 10 years down the road, it's a lot.